In this last recording, we're now going to take a look at this last statement, the statement of cash flows. So again, we've looked at the statement of financial position, which is a snapshot at a point in time, like a statement of affairs. We've looked at the statement of profit or loss, otherwise known as the income statement. That's an accounting view of wealth generation, profits, which is income earned less expenses incurred, not necessarily money in, money out. The last thing we're looking at now is the statement of cash flows. And this is probably the easiest one for most people to understand is what were the sources and uses of cash? Where did the cash come from and where was the cash used? And that can be different than profit. We'll see that in the next slide and we'll talk our way through it. This is also going to be very useful for the likes of entrepreneurship module next year, where you're going to have to do cash flow projections for a new enterprise and do a cash budget. So understanding that link in terms of cash flows and financial statements is hugely important. Statement of cash flows has a standardized layout. They look at three different headings: cash flow from operations, which is what cash is coming from the day-to-day running of the business; cash flow from investing, so selling property, plant and equipment, buying property, plant and equipment; or cash flow from financing, raising new finance, repaying old finance, paying dividends. And that's important because as a user of a set of financial statements, you will get a good idea then where is the sources of cash coming from. Are they coming from operations, investing, or cash financing? And where are the uses of cash going? So it gives you a good idea of the sustainability of the cash flow in the business. Right? So if we take Ryanair, for example, and we go back and look at their profitability. So we look at Ryanair here. Profit for the year, 1.45 billion. Right? Profit for the year. If we go to the statement of cash flows for the year, bring it down here. Actually, the net cash increase of cash equivalent was only 291 million. So even though you started with the 1.4 billion profits, you only increased your cash pile by 291. And if you look at last year, you made 1.3 billion profits and you actually reduced cash flow overall. Cash went down by 35 million. That's the net increase or decrease. That's the opening balance of cash. That's the closing balance of cash. So what we can see from Ryanair's perspective, well, if you're looking at the profit after tax and going to net cash from operations, some of the key differences are: one is you adding back depreciation. So what we mean there is when you buy planes, that will be capital expenditure. So see you buying planes down here, they spent 1.4 billion on planes, which is not an expense. It doesn't go into the profit or loss statement. What does go into the profit or loss statement instead is this thing called depreciation, which is essentially like wear and tear every year. It's not a cash flow, it's an accounting adjustment. You're writing off the cost of the asset over its useful life. So what we're saying is, although you made profits of 1.4, that's actually a non-cash adjustment. So your true cash flows, if you're trying to work back, is going to be 561 bigger. Then you have a couple of small adjustments for movements in working capital. So trade receivables, trade payables, and then you take off your tax paid, actual tax paid to the tax authorities. So you made about 2.2 billion from operations. So what we would say here, Ryanair is cash generative. It's throwing off cash from its operations. It's then investing cash in planes, 1.4 billion, but it's also now this decrease in financial assets. What that means is it sold short-term investments during the year and partly used that to pay for its planes. So it has some cash tied up in maybe government bonds, etc. It released those back into the cash reserves. And it also paid out 829 million to shareholders, typically either share buybacks or through a special dividend, and it repaid some of its long-term debt. So you can see here the sources and uses. The main source of cash here is operations, year on year. Spends some on buying new planes, and then it spends a lot returning to investors, either paying back loans or paying back to shareholders. Shareholders have got about 3 billion over the last 3 years in these financial statements. So it gives you a good idea. They still have a good kitty of cash, but they are returning the profits that they earn back to the shareholders in the form of typically special dividends, or sometimes they'll return it in the form of share buybacks, where they buy back shares in their shareholders. It just gives you a good idea why the differences are. Certain items like repaying loans, like payments to shareholders, like capital expenditure, they won't be in the profit or loss statement. They are not what we talk about wealth generation, and that's why there's key differences there that you need to watch. Same if you look at, for example, the Grafton Group. Grafton Group made 150 million profit in 2018, the group income statement. You come down here to the cash flow statement, the net increase or decrease in cash, they actually lost 31 million in cash, reduced. They made 178 million from operations when you deal with all the adjustments. So you're adding back depreciation there again because it's non-cash. They actually gained cash from investing. They sold off properties, they sold off plant and equipment, and they spent an awful lot on acquiring new businesses, acquisition of subs, purchase of property, plant and equipment. So their net cash outflows was investing activities. And then in terms of financing activities, it was a net outflow as well. Although they drew down new borrowings, they took in new loans, they paid off old loans, and they paid a dividend to shareholders. So you can see here 178 in from operations, but 122 out in investing and 87 out in financing. So again, you can see where the sources and uses of cash come from. That's very important. If you go now and you look at a newer business, look at a Facebook, look at Uber Eats, and those businesses that are listed, you will see their operating activities are hemorrhaging cash because they're not mature businesses. Where the cash is coming from is financing. People are putting in new rounds of funding in the hope that in the future the business will mature and it'll start throwing off cash. So take a look at those in terms of the sources and uses of cash. Just because you're profitable doesn't necessarily mean that you're going to be throwing off cash for a variety of different reasons. And that's a nice one to understand is it's one thing looking at the profit figure, it's another thing looking at cash flow. You need to look at both to get a full picture of an organization. And we're going to pick that up in week 8 when we do a class example looking at analyzing a set of financial statements. So if we look at the relationships then between the statements, the statement of financial position is at a point in time. What the income statement and statement of cash flow do is look at the movements in all those items over the period. So the movements in the income statement, the movements in the statement of cash flow will help you explain how you got from one position to the other. So they're a package of financial statements. They all tell different aspects, but they're all vitally important in terms of understanding the dynamics of a business and understanding the position, with financial position and financial performance of an organization. So they are important just to get an idea of an overview. And it's no harm, go and pick another set of financial statements. Get your employer's set of financial statements if you can, through the CRO, or you might have an ultimate parent at the listed company, have a read through them. Get a picture of what you're seeing and look at the commentary that's there as well at the front end of the annual report, which we'll look at in a second. And that's just a kind of summary then of what the key elements are. There is a standardized layout of the financial statements for each one. The different subtotals you have in an income statement, the different headings you have in a statement of financial position, and the different headings you have in a statement of cash flow. The reason we have that regulation is to allow comparability. You want student or users financial statements, stakeholders, to be able to compare and contrast across different years, so consistency, but across different companies as well to benchmark performance. So that's the finish of looking at the 3 key financial statements, and hopefully that's going to set you up now so we can hit the ground running in week 8 to analyze and interpret a set of financial statements. The only other small thing I wanted to touch on briefly is the annual report. Now this is pretty much the main mechanism through which organizations communicate to stakeholders, and it's a big report. One key section of which is the financial statements. And we've seen a bit of that already. That will include the auditor's report. But PLC companies will publish a huge amount of more information. So if you look, for example, here, let's just look at the Grafton Group. Look at the front end. Firstly, it's 204 pages of a PDF. But if you come to the front end, you look at for example, the contents. Typically, this is the structure you'd have in most annual reports for companies. You'll have a strategic overview. So it's overview of the business. You'll have a letter from the CEO, you'll have a letter from the chairman, just seeing how the company got on in general. Then you have a big section on corporate governance. We looked at that the last day when we looked at remuneration. Remember, a performance measurement? What are the CEOs earning? What are the bonus schemes based on? What does the remuneration package look like? That's a hugely detailed section because of corporate governance. There's certain rules that have to be abided by listed companies, and all that is listed there. Who the board members are, what activities were during the year, how were certain policies determined. Then you come to the section we're focused on, financial statements. You have the auditor's letter, You have all the financial statements, and then you have the notes to the financial statements. The notes could be 100 pages long. The financial statements themselves might be 5 or 6 pages. So it gives you an indication how important that is. One thing that isn't in this that you might see in other organizations is the corporate social responsibility is quite short here. It's just a small section as part of the overall annual report. What some companies are doing now is taking out the CSR section completely and doing a separate sustainability report. So if you look at someone, for example, like CRH, Smith Roadstone Holding PLC, they'll have a separate completely sustainability report. And that's becoming more mainstream now as there's a bigger demand from stakeholders for non-financial or what we call ESG, environmental, social and governance information, just to get an idea from different aspects how the business is performing. So expect to see a lot more of that. But you'll see from a lot of these annual report, Ryanair, 208 pages, Concern, only 96. If you looked at one of the banks, AIB Bank of Ireland, you could have 300 pages. Because it's a regulated entity, it needs a lot more information. So it's just to get an idea, this is the main mechanism. But the problem is it's becoming bigger and bigger. The more stakeholders want more information, the more regulation there is in accounting standards, the bigger it is and the more cumbersome it becomes to actually interpret and be useful. So you can see there the different sections you'll have. You'll always have an overview of the business. They'll tell you who is on the board of directors. They'll tell you who's on the key senior management team. They'll give detail of how they run the business, the different governance structures in place. And generally, they'll tell you about CSR. They might label it sustainability or they might keep it as a separate report. But that's the next big paradigm shift for accounting now is how do we have this integrated report, financial report and sustainability and ESG all together. It's not there yet. There is a lot of moving parts, but that's where they're working towards, is to get a comprehensive report. The problem is you could have hundreds of pages, and whether that's going to be understandable and engaging for stakeholders is a whole other debate. So you can see the annual report. There'll be a couple of questions now, and you'll see in some question packs around this, but it's getting hugely big focus and it's getting bigger and bigger every year, going from hundreds of pages up, increasing year on year, 10, 20 pages extra every couple of years. Why? Well, one, increased regulation. There's just more requirements to meet. More stakeholders want more information. They want information about workforce, social aspect. They want information about gender diversity, pay gaps. They want information about carbon footprint. All of this is going to be put in together. More accountability. People want more transparency. They want more information about tax policies. Are you paying your fair share of tax? There's more sophistication from user groups. So analysts now want more real-time information. They want more granular information because they have the analytical ability to analyze it. Another obvious reason why the annual reports are increasing is businesses are getting more complex. They're bigger businesses. They're more diversified. So they're bigger segments that to explain each one. They have more scope in terms of geographics. They're involved, they're multinationals now. So then you have to explain a lot more than the traditional business, which might have been domestically focused in the past. But the problem with that is it's growing and growing in size. And you'll see a lot of studies now are saying they're becoming too big to be useful. And you will see that when you look at a 200 or 300 page document. It's very hard to sit down and read all of that without being an expert in the area and being confident that you've interpreted everything as you should. So take a look at the couple of reports that I've put up there. Grafton Group and Ryanair, the traditional what we call commercial PLC businesses. But then take a look at Noonan, which is a subsidiary now of a bigger company. I got that from the CRO. If you know the company's name, you know the company's number, you can go and find a set of financial statements, right? Whether it's a small company, maybe one person operation that's a limited company, or a big subsidiary of multinational, they should be available through the CRO. You can get the annual return, you can get the set of financial statements for a small fee. And that's how I got the Noonan ones. Have a look at the way they lay out theirs, and then have a look at Concern, kind of a not-for-profit, the way they lay out their annual report and set of financial statements. It's still an annual report, same principles, but again, they're focusing on different aspects. And look at the different language used around capital, around profit, around wealth. It's a different language because I suppose there's a different overarching agenda and different overarching strategic objectives as well. All right. So that last short recording now looked at the statement of cash flows, and it also looked at the whole area of the annual report. We're going to pick this up now in the live sessions in class in week 8. We're going to recap all the 4 recordings, which hopefully you've got a chance to look at. I'll deal with any Q&A, explain any of the topics that might have been causing students issues, and we'll kick straight in then to the area of financial statement analysis. How do we read a set of financial statements? How do we pick out the key issues? And how do we conclude? How do we make recommendations based on that? So I'll see you all in week 8 in class.